Hello, welcome again. Let's now go through a detailed example. Golfi Limited produces a professional grade vacuum cleaner and began operations in 2018. For 2018, Golfi budgeted to produce and sell 25,000 units. The company writes off under or over allocated overhead to cost of goods sold. Actual data for 2018 are given as follows. Actually produced, number of units produced 21,000 units, units sold 18,500, and selling price $432. Variable costs, production cost per unit, direct material $33, direct production labor $23, production overhead $62, and this is variable part, and marketing cost per unit sold 46. And fixed costs, production fixed cost 1,550,000, administrative cost 906,300, and marketing fixed cost 1,475,000. So what we are supposed to do? Prepare a 2018 income statement for Golfi using variable costing. Prepare a 2018 income statement for Golfi using absorption costing. Explain the differences in operating profit obtained in requirement 1 and 2. So what's the impact of our costing system on the profit? We will be able to see that. Why? We'll be able to explain it. And requirement 4, Golfi's management is considering implementing a bonus for the supervisors based on gross margin, gross profit under absorption costing. Advise management on the potential impact of the bonus plan on the behavior of supervisors and recommend modifications that Golfi management might make to improve the plan. So Golfi Limited is planning now to provide bonuses to the supervisors, production supervisors, based on the gross profit calculated according to absorption costing. Is it the right approach? And if it is, or whatever, what may be the impact of this bonus plan on the behavior of the supervisor, and what sorts of steps company should take or company's management should take to improve their plan. So let's see the income statement based on variable costing, first part. As we know, income statement. So sales revenue, number of units sold multiplied by sales price is very simple. Number of units sold given in the question. Units sold 18,500, sales price 432. Okay, so it's 79,092,000 is the revenue, and now less variable cost of goods sold. Okay, variable cost of goods sold. Find out variable cost of goods sold. As we know, cost of goods sold equal to beginning inventory plus production minus ending inventory. But in case of variable costing, we will consider only variable manufacturing cost. And variable manufacturing cost are material, labor, and production overhead, which is variable. Okay, so 33, 23, and 62. So if you add this 33, 23, 62, 118, and how many units actually company produced is 21,000. So 21,000 times 118, so 2,478,000. Okay, that's available for sale, and there was no beginning inventory given in the question. So ending inventory, they produced 18,500, sold 18,500 from 21,000 production. So remaining 2,500 is ending inventory or closing stock. Okay, so the closing stock is 295,000. That is 2,500 times 118 should be. And then if you deduct ending inventory from goods available for sale, less, then you will get variable cost of goods sold. And variable marketing cost should be calculated for units sold. That is, units sold is 18,500 units sold, and marketing cost variable part is 46 per unit. So 46 times 18,500. So this is what the variable marketing cost. Okay, so these two total is the total variable cost. And if you deduct this total variable cost from sales revenue, you will get contribution margin. Okay, and then deduct these two fixed cost from here. So contribution minus fixed production cost and fixed marketing and distribution cost. It's given in the question. Okay, fixed marketing and fixed production cost and administrative. All these fixed cost, if we deduct from here, marketing distribution, we add it together, and then you will get net profit, net operating profit, according to variable costing. Let's now see absorption costing. Income statement, according to absorption costing, sales revenue is same, yeah, and you have to calculate now cost of goods sold, not variable cost of goods sold, because in absorption costing we will consider all production cost in product cost. So it's cost of goods sold, we'll calculate according to the same approach, that is beginning inventory plus cost of production minus ending inventory. But cost of production per unit, we will now consider variable part and also fixed part. Okay, so fixed production cost is also being added. So this is material, labor, variable overhead, and fixed overhead. The fixed overhead is fixed production overhead 1,550,000 divided by budgeted production units. The company budgets to expect to produce 25,000. So per unit budgeted production overhead cost is 62. Add this together, 180 is the per unit production cost multiplied by 21,000 production units. So if you add this together, if you multiply 21,000 times 180 per unit cost, then you'll get 37,080,000. 3,780,000 is the cost of production. And then deduct ending inventory, ending units 2,500 as we saw before, 21,000 production, 18,500 sold, so 2,500 ending inventory, 2,500 times 180. So you'll get ending inventory. If you deduct ending inventory from production cost or available for sale, then you will get cost of goods sold, budgeted according to budget. But the problem is, according to budget, we are supposed to produce 25,000, but actually we produce 21,000. So if you produce 21,000, you charged fixed cost only for 21,000 in the production. But what about remaining 4,000? Fixed cost for remaining 4,000. The remaining amount should be adjusted here as under absorption. Budgeted 25, actual production 21,000. So under production, right, 4,000 units. So 4,000 times 62 for 21 times 62. Then if you deduct it from the budgeted fixed overhead, then you will get 248,000. And this is what is under absorbed production overhead that we need to adjust with cost of goods sold. Then if you add this together, this is what we didn't consider here. Okay, and that's why this cost of goods sold is actually a lower figure, is less. It actually doesn't reflect our total cost because we charge fixed overhead for 4,000 units. So this is what we need to, as it is a fixed cost, though we produce less, but our expenditure will not reduce, will be actually 1,550,000. So that's why we need to add this figure. So our actual cost of goods sold is this 3,578,000. Okay. Then if you deduct this cost of goods sold from sales, then you will get gross margin or gross profit. And then deduct marketing and administrative cost. So marketing, administrative, fixed cost and variable cost all together. Okay, so variable cost you need to consider only for variable cost of only for the sold units, 18,500 times 46, and plus administrative fixed cost this and marketing fixed cost this. So this figure, and also 46 times 1850, then you will get total marketing and administrative cost, fixed and variable. And then you will get net profit, all right, 1,181,700 according to absorption costing. Now the differences actually is why the difference happened is basically because of the inventory, right? Inventory costing. Absorption costing, production cost include all fixed production cost. If inventory increases, variable cost will normally have lower operating income than absorption costing. So if inventory increases, then what was your beginning inventory and what's your closing inventory or ending inventory? If ending inventory is more than opening inventory, then your profit in absorption costing will increase. Why? Because the product cost in absorption costing is higher. It includes fixed manufacturing cost, right? And the fixed manufacturing cost in the inventory amount is transferred to the next period. It's not being charged as the cost of the current period. And that's why the cost of the current period is reduced by the amount of fixed cost that we charged on the inventory amounts. So the fixed production cost is actually carry forwarded to the next year, and which actually makes the difference between the profits between absorption costing and variable costing. And I have shown here the difference. The difference between the profit under absorption costing that we have calculated 1,181,700, profit under marginal costing that we have calculated 1,000 and 26,700. Okay, so the actual difference between the profit is 155,000. Okay, and differences in inventory valuation. What are the differences in inventory valuation? According to absorption costing, this is what the ending inventory minus opening inventory. So the difference is 450,000. And in marginal costing, inventory costing was ending inventory 295,000 minus opening inventory 0, so 295,000. And what's the difference in inventory valuation between the methods, absorption costing and marginal costing, is actually 155,000. So what's the difference in your profit? 155,000. And what's the difference in your inventory valuation? 155,000. So actually the difference has been created or made because of the differences in our inventory valuation. And the fourth section of the question asks us to advise company. Company has a plan to provide bonuses to the employees based on the profit according to absorption costing. So according to absorption costing, if company provides the bonuses to the managers, what they can do, company supervisors or managers will try to produce more products. Okay, if their production is more, then their inventory will more. If the inventory is more, then they will get more bonuses from the company. So company should be cautious in case of determining the bonus according to the profit of absorption costing, right? All of these will increase. So for example, switching to production that absorb the highest amount of fixed cost. So managers can produce that product more, which requires more fixed cost, or they can just accept order, right, to increase their production volume, or they can increase their production volume, right, by increasing production and again producing instead of not stopping for maintenance, right? So all these points actually will increase the volume of production of the company. Ultimately, it will, in the long run, it would be a great loss for the company. So, and that's why companies should be cautious in case of providing bonus according to the profit. Arguments for variable costing. What are the benefits or positive side of the variable costing? Is it provides actually more accurate information, useful information for decision making. And variable costing, and that's why variable costing is used for internal decision making. Okay, the income statement that we prepared according to variable costing is used for internal decision making or their own decision making, and it actually usually shows lower amount of profit, real profit of the company. Removes impact of inventory alterations. Okay, whether the inventory is altered, increase or decrease, this doesn't impact, right, on the profitability, right? If inventory increase or decrease doesn't have any impact on the profitability. Avoids overhead being capitalized into unsellable inventory. So if there is an inventory more or less, right, so it's not being capitalized, it's not being recognized as the cost of inventory, right? So the capital or fixed overhead is not charged on the product, and that's why the cost of inventory is not being recognized as an asset for the current year. Is not being carry forwarded, right? And that's why these information are actually real and actual in case of making decision. But there are some benefits in case of absorption costing or traditional costing. And this traditional costing usually companies use for external reporting. So when they prepare any statement for other people, outsiders, the people who are outside, bank, government, customers, or other people outside the organization, the companies prepare income statement according to absorption costing. So the benefits, it includes all the fixed overhead on the cost of the product, and then it actually shows the total cost of the product. What is the total cost of a product? Is it recognizes on the product. Absorption costing doesn't. Avoid fictitious losses, right? In case of absorption, it doesn't show any fictitious loss. And consistent with external reporting requirements. So external reporting requirements, the guidelines for reporting to the external people, accounting standards or reporting guidelines is actually absorption costing, not variable costing. So if you want to prepare any report for outsiders, other people, you have to prepare according to absorption costing. The fictitious losses, there's a question that you just saw in the previous slide. What is the fictitious loss? The fictitious loss, it happens to the organization when the company has seasonal business. In one season, they have lots of production, and other season, very low production, but lots of sales. Okay, so when you produce sales doesn't happen at that time. But when you sell, right, the production is kind of stopped. And that's why the cost charge on it in a period when there is no activity. All right. And when there is lots of activity, there is no cost. And that's why the reporting result, if you prepare income statement for a period when there is low sale, but lots of production, you will see there is a loss. But that's actually not loss for the company, right? And this is what situation can happen, right? In case of seasonal business. So we should be cautious about if a particular company shows loss in a particular period. It doesn't actually mean loss. It depends when the company is selling its product, not producing. And yeah, absorption costing in seasonal business, right? So in absorption costing, fixed overhead deferred and included in the cost of inventory, as we know, and only recorded as an expense when the product is actually sold. So therefore, the losses are therefore mitigated in the low season. Okay, when there is no activity, that is, and you will see lots of profit, right? There is no expense, the profit is being actually happen. So it happens in case of absorption costing. It can happen, but variable costing doesn't show this kind of situation. And there are some tips for avoiding some kind of common mistakes in preparing income statements. So you have to calculate actual overhead rates when preparing absorption costing profit. Normal or budgeted activity should be used, right? In case of calculating the fixed overhead rate, as I show you there, you have to use the fixed but budgeted production and compute the different actual overhead rates for each accounting period. So if you have multiple accounting periods, if for example, if you are given, there are some examples you will see in the seminar, the 2 different periods. So you have to calculate overhead rate for 2 different periods separately, okay? And exclude non-manufacturing overhead in the inventory valuation for variable costing and absorption costing. Non-manufacturing cost is not being considered as product cost in none of the approaches. And variable selling overhead is like sales and not production. Variable selling overhead should be considered only for sales units, not for production units. All right. And under absorption or over absorption, if your production is more than budgeted, then it is over absorbed. Then in that case, the figure, the over absorbed amount should be deducted. In the example that I showed you a few minutes before, it's under absorbed, and that's why we added the cost together. All right. And this is what the summary of what we discussed today, the marginal costing and absorption costing. So marginal costing or variable costing provides more useful information than absorption costing, particularly for internal decision making. In variable costing, profit is function of sales, whereas in absorption costing, profit is a function of both sales and production. All right. In variable costing, fixed overhead are not capitalized, right? Are not being considered as the cost of inventory. But in case of absorption costing, sales can increase yet profit is declined. Okay? This is what can happen because of the seasonal business, as I mentioned before. So when there is sales, there is no production. When there is production, there is no sales. It can happen. So you produce in a particular season and then sales throughout the year or other periods. And absorption costing doesn't understate the importance of fixed cost. This is for the importance of absorption costing. It includes all the fixed cost in the product. So it doesn't understate the cost. And absorption costing avoids the possibility of fictitious losses. Absorption costing avoids the possibility of fictitious losses, right? It mitigates that. In absorption costing, fixed manufacturing overhead are impounded to the product or service cost that is being included in the product and service cost, right? And absorption costing is consistent with external reporting. If you report for the other people, outsiders of the organization, for the government, for bank, for financial institution, for the shareholders, for other people, then you have to prepare your income statement according to absorption costing approach. But if you prepare for internal decision making for your own use, you can prepare according to variable costing. And that's all. Thank you very much. And if you have any question, ask in the seminar, and you can contact with your with any of our tutors. Thank you very much. Wish you all the best for your face test. Thank you very much.